Welcome to another video from Inzara.com. In today's video, we'll be looking at the Indian banking sector and we'll be doing an analysis using several stock market metrics, and we'll be using those metrics to identify the top performing banking sector stocks. And also at the end of the video, I will demo how we can actually use a stock ranking model to find the best banking sector stocks for your specific investment profile. For example, if you're an aggressive investor, which are the top banking sector stocks? If you're a moderate investor or if you're a conservative investor, we've got you covered. So in this video, I'm going to walk you through not only the results, but also all the specific metrics that we'll be using for analysis. And I'll be explaining those metrics so that you understand what they mean and how we calculate them as well. So before we get started with the analysis, the data that I'll be using for this analysis comes primarily from the Microsoft Stock Market Service. If you have a Microsoft Office 365 subscription, then you can actually pull the market data into your Excel spreadsheet, and that's what I've done in this video when I did my analysis to bring the data from Microsoft Stock Market Service. Now, dividend data is not available there, and so I have manually collected the data from Yahoo Finance on dividends. All the data here is as of February 14, 2025. Obviously, when the data changes, the insights also will change. So all of the analysis that we do, please consider that is as of February 14, 2025. Now, let's get started. So the first thing I want to talk about is a sector overview. So all the stocks in the banking sector, let's get an overview of the size and as well as the important players in this sector. So first of all, the bank stocks, when I look at all the bank stocks and the market capital, 29% is from public banks and then 71% is from private banks. Now, what is a market capital? So market capital is nothing but, let's take a very simple example. If a company has 100 shares outstanding total and each share is worth 10 rupees, then 100 times 10, 1000 is the total market capital for that stock. So similarly, if you look at all the bank stocks, including private and public, so I'm looking into 12 public banks and 28 private banks here. And totally, if I'm looking at the market capital, 71% of the market capital is from private banks. So this gives you a size of the important players and whether they are public banks or private banks. When it comes to the specific names of the players who take the lion's share of the market capital, HDFC Bank, 27%, ICICI, so they both together make up the 46% of the total market capital for the banking sector. And State Bank of India is the largest public bank with 14% of the market cap. Now, in addition to the market cap, which represents the size of the players, the other part is the average daily volume. So essentially in the market, if you look at the daily trading volume of all these banking sector stocks, and I try to average it for the last 30 days, then I can calculate the average trading volume. So when I look at that, 37% of the volume comes from the public banks, and then the 63 from private banks. So you can kind of get an overview of this banking sector. This is only the stocks. Now there is also the other part of the picture, which is called as ETF or exchange traded funds. Exchange traded funds, you trade like a stock, you buy and sell just like a stock in the market in the exchange, and that's why it's called exchange traded funds. And these are funds that are managed by fund managers to track a specific sector's performance. Since we are focusing on a banking sector today, so the banking sector ETFs will be managed by the fund managers to track to the banking sector performance overall. This specifically includes investment into 12 different banks. So let's take an example exchange traded fund. This is a Nippon India ETF, Nifty Bank Bs, and this is one of the more popular ETFs. And if you can see here that if you're investing money into this ETF, your money will be taken by the fund manager and invested into these 12 banks in this proportion. So if you're investing 100 rupees into this ETF, 27.62 will go to HDFC Bank, 25.04 will go to ICICI Bank, and so on. So what is the benefit of doing this? So this is something which helps you to diversify within the same sector. So for example, if HDFC does well, but then Bank of Baroda doesn't, or the other way around, so you're covering and mitigating your risk by diversifying your investment into 12 different banks instead of putting it into one bank. So that is the one benefit. There is a little bit of a cost to it, which is called the expense ratio, which will be presented to you when you're investing in ETFs. But that expense is just to cover the cost of the fund managers and everything to manage these funds. But apart from that, now the other thing which is beneficial with ETFs is a convenience. So for example, instead of me taking the time and buying all these 12 different banks stocks, now I can put it into this ETF, and now I'm getting exposure to 12 different banks. So the convenience factor is there as well. So now this is an ETF, and there are about 12 or 13 different ETFs in the banking sector in India. And if I'm looking at the top, ETFs in the banking sector in terms of the market cap again, the top three are the Nippon India Nifty Bank Bs, which is what we're looking at, and also Kotak Nifty Bank ETF and SBI Nifty Bank ETF. So these three are the top three in terms of market capital. So now that we get a good picture of who are the key players, what are the important ETFs and stocks, we're going to be doing the analysis now, and we'll be looking at totally 12 different public banks, 28 different private banks, and 12 different ETFs. So totally 52 different items that we're going to be doing the analysis and finding out the best stocks for investment based on a specific investment profile. Now, before we start looking at the actual performance, there's one more thing I want to show you, which is called the index. So this is called a sectoral index. So Nifty Bank index is a sectoral index. So essentially, this index is something that you cannot buy or sell or trade in the market. This is just for tracking purposes. The 12 banks that we kind of looked at, so these 12 banks are taken to be representing the entire banking sector. So in order for you to understand the performance of the banking sector overall, instead of looking at so many stocks, you can just look at this index. Secondly, this index can be compared with other sectors like auto or other sectors if you want to understand the performance of the specific banking sector. Let me take an example of comparing the Nifty Bank Index with Nifty 50. So for example, the blue line represents the Nifty Bank, and then the gray line represents the Nifty 50, which is another index which tracks the top 50 companies. Now you can see how both indexes have performed over time. Summarized the increase or decrease in terms of the price of these two index. Now, within the last, if I'm looking back at 5 years or 3 years, Nifty 50 has outperformed Nifty Bank. However, in the last 1 year, Nifty Bank has outperformed Nifty 50. So that is the overall takeaway that we can have. So this kind of gives a broad overview of the sector compared to the Nifty 50. And so far we have looked at the ETFs that are available, private versus public banks. So now we have completed the initial overview or lay of the land kind of view on the banking sector. Now let's get started with the stock performance measurement. So when we talk about stock performance, what we are measuring is how the price of the stocks that we are looking into have improved or decreased over time. So for example, we can take a look at the last 3 years. Let's say Karur Vysya Bank's stock has improved 60%. And so how do I get to 60%? So if I'm looking of like 3 years ago, that'll be 2022. And at that time, what was the price for each share of Karur Vysya Bank? And I compare that with the price of Karur Vysya Bank stock today. How much has it changed? It's increased by 60%. So this is representing the performance of the stock price in the market over the 3-year window. Now, it's important for us to get familiarized with this view. I'll just explain the icon. So the icon, whenever you see this diamonds, 4 diamonds icon, that represents it's a private bank. So Karur Vysya Bank is a private bank, South Bank, KTK Bank, these are private banks. If there is no icon, that means it's a public bank. Now, if I'm looking at 3 years and 5 years, so two different time horizons, for the purpose of this analysis, I'm considering the 3 years as a medium term and 5 years as a long term, and 1 year will be the short term. So for the medium and long term, if you look at the top 10 stocks in terms of price improvement or increases, now you see in 3 years, Karur Vysya Bank, Indian Bank is second, UCO Bank is third, and so on. Now, if we try to see a broader pattern, public banks, 6 out of the top 10 performing banks in each of these time periods is a public bank. So 6 of the top 10 are public banks. And the other important pattern here is you don't see any ETFs. Again, remember that I'm analyzing 52 different stocks and ETFs belonging to the banking sector in this analysis. So out of those, ETFs don't make it to the top 10 at all. So what does it tell us? ETFs don't give you that high rates that these banks were able to give in the 3-year and 5-year window. Now, let's look at the short-term window. Within the last 1 year, Karur Vysya Bank again tops it, 26% increase in price. And now you see a slight difference in terms of the pattern, because in the short term or in the last 1 year, ETFs are making it into the top 10, and also the private banks kind of dominate the top 6 positions in terms of price improvements. Now, specifically, you can see the top 6 private banks, and from a public bank perspective, as of today, only 2 public banks are showing a positive return within the last 1 year, Indian Bank and the SBI. And again, they don't have like such high percentage return, but at least they are positive. But all the other ones are negative. So this is the overview of the stock performance across the short, medium, and long term. And again, we will summarize all this. And again, our point is not to give 10 different stocks. We want to get to the top one that we want to invest in ultimately to help us make smarter decisions. So we'll get to that. But this is to understand the foundation, which stocks are performing, which top 10 are performing in terms of stock price increases. Now let's move on to the volatility. Is a measurement of how the price is fluctuating for a stock in the market over time. So it's a measure of risk that you're taking. And we are using, technically speaking, we are using the standard deviation calculation to measure it. And then that's what we're calling it as volatility. And it's a measure of risk. Now, what is volatility? So if you look at this chart, now what you see is 2 different lines for one of the ETFs, and the other one is for a Suryodaya Small Finance Bank Limited stock. The lines represent how much the price has changed day to day as a percentage. Now, if it goes below 0, that means the price dropped. If it goes above 0, it means the price increased that day. Now, one obvious thing you can see here is that the orange line, which represents the Suryodaya Small Finance Bank Limited, has more dramatic ups and downs. So the price goes up, by a lot, 15% here, again another 12%, but it also has, kind of steeper, declines or drops, where it drops by 12%, it drops by 7%. So compare that to the ETF, where the blue line is fluctuating less. It is fluctuating, but it's fluctuating less compared to the orange line. So you can see here the volatility or the fluctuation is different for different banks or stocks. Now, this is what we are measuring. So let's say we measure this volatility over different time periods. So within the last 1 year, within the last 3 years, within the last 5 years, I'm doing the same thing. So now you are familiar with this table, the top 10 table. And now you see the icon for ETFs, which is this one. And you'll see that the ETFs are dominating when it comes to the best performing stocks in terms of volatility. Best here means lowest volatility or lowest risk involved or lowest fluctuation. So the ETFs are dominating. That's a clear pattern. And when you go back to a longer window of time, ICICI Bank, HDFC Bank start coming into this mix. So they're also a couple of those stocks which are less volatile. So meaning they don't really, have that dramatic fluctuation. And so those are the main takeaways. And then there are a few other banks. If you look at the long-term window, 5 years, State Bank, Axis Bank, and then also Kotak Bank kind of come to the mix. But ICICI and HDFC clearly stand out in terms of more consistently stable, in terms of the fluctuation. Now this and the previous slide where we saw the performance, now we're getting to the performance and the volatility piece, which are always, if you think about it, the more volatile it is, let's say it's more risky. Generally speaking, the more risky it is, more rewarding it is. So how do these things kind of work together between stock performance and volatility? And that's what we will call it as risk versus reward. First, let's look at risk versus reward in the long term. So we already saw in a 5-year span, what are the top performing stocks in terms of price increases. We also saw what are the top stocks in terms of volatility. Now you can see them, but now how do I put them together and visualize? So this is my attempt to visualize the volatility and the return, risk and the reward. And the way to read this chart will be on the x-axis, we have the volatility. On the y-axis, we have the annualized returns. Now, if you split this into quadrants, what we can interpret here is the further to the right of our screen, that means that the risk is increasing. The further to the top of our screen, that means the returns are better. So ideally you want banks or stocks which are in the top left corner, which means risk is less and the return is higher. But if they are in the bottom right corner, which means the risk is higher and the returns are low, that is the worst option for us. Now, typically, you will see more stocks in the diagonal from the bottom left to the top right. And that means if the risk is more, the return is more. If the risk is less, return is less. That's more common. But in here, now we are looking at a 5-year span of analysis. And for the 5-year window, you can see that the blue diamonds, which represent the public banks, and then the green circles representing the private banks, and then the orange tiny circles represent ETFs, and then there is a purple square which represents the overall banking index, Nifty Bank Index. Now the way to interpret this would be overall the blue diamonds, which are public banks, are slightly more volatile than a majority of these private banks. However, the public banks do have better returns. So generally speaking, the blue diamonds are in the top right of the quadrant. Now, there are exceptions. You can see these two green circles at the top. These represent two private banks, which are J&K Bank and Karur Vysya Bank. They have very good returns, as well as they are in line with the volatility with the public banks. So they stand out. But overall, you see a pattern where public banks have higher returns in a 5-year span, and then their volatility is a little bit higher as well. Now, ETFs are interesting because they, as you see here, they are on the leftmost of all the banks and ETFs, which means that they have the least risk involved. So they have the least risk, and you will also notice that they are very close to the Nifty Bank Square. What that means is that the fund managers who are taking the funds and in the ETFs to allocate it to the different banks, 12 banks, they are staying very close to the overall Nifty Bank Index performance, which is good because that's what the ETFs are supposed to do. And so they are staying very close to it, and they are actually the least risk of all these investments that we see, which is very good from a risk mitigation perspective. So the ETFs are there. They don't give you the high returns like some of these other banks at the top. However, they also are not giving you negative returns like some of the private banks at the bottom. So say somewhere in the middle. Now let's look at the medium term in a similar context. The medium term here is 3-year window, and I'm looking at the same chart for 3 years. And now you see the blue diamonds, which are the public banks, are more clearly to the right side, which means more volatile, and they are more on the top right corner, which means they're also having higher returns. So clearly there is a pattern here. The public banks in the 3-year window and the 5-year window, they have more volatility and more returns. But there are a few private banks which actually act as exceptions, like the Karur Vysya Bank, South Bank, KTK Bank, and J&K Bank. Those 4 green circles you see at the top, They are those exceptions, but otherwise there is a general pattern with the public banks versus private, and the ETFs stay as the least risky option, continues to be the least risky option, but they do have almost 10% return here. So their returns are better than a lot of the private bank stocks as well. Now let's look at the short term, which is the 1 year window. 1 year window has always been different from the medium and long term, and even in this chart you can see that is being represented. So the blue diamonds, which are the public banks, now they are not in the top right quadrant, they are actually in the bottom right quadrant, which is actually not a good place to be in. That means they have higher volatility, and also they're all negative returns. You can see the zero line here, and there's only two, as I said, Indian Bank and State Bank of India are the only ones that are barely positive, but everybody else is negative returns in the last 1 year. So public banks not in a good spot when you look at the last 1 year. When you look at the private banks, there are a few that are at the top. They have not only high returns, but their volatility is also very low, relatively speaking here. And so they are the Karur Vysya Bank, ICICI, Federal Bank, HDFC, and City Union Bank. Those are the top 5 circles that you see there. Now ETFs, now you can see that ETFs are no longer like in the middle, they're actually in the top left quadrant, which is the best quadrant to be in, which means that the returns are pretty good and the risk is less. So except for those 6 private banks which seem to have better returns, ETFs are pretty good, and that's why ETFs ended up coming in the top 10 in the last 1 year of performance. So ETFs are becoming an attractive option, recently speaking. Once again, the ETFs are tracking very close to the Nifty Bank overall index, except this one ETF, which is I think a relatively new one, so it doesn't have a lot of history, so I would ignore that for now. But all the other ETFs which have been there for a while, they are pretty close to the purple Nifty Bank index. Okay, now we have seen visually the risk versus reward, and overall 3 to 5 year pattern is different, and then ETFs are attractive. Karur Vysya Bank is very consistently performing across all the different time frames. So those are the big summary points now. But you may ask, like, now looking at it on the chart in a scatter plot, that's fine, but how do I know which is better? Do I have to look at how far off the dots are on the chart? No, we can do better. I think that visually looking at it gives a good perspective of the risk versus reward, but we can do better in terms of quantifying so that we can order them or sort them better. So that is where risk adjusted returns concept comes in. So risk adjusted return is nothing but looking at the return while also considering the risk involved. So when we looked at a scatter plot, we are looking at risk and return in X and Y axis, but can we do a calculation based on that and come up with a number? That's the purpose of risk adjusted return. So there are a couple of important ratios or popular ratios that are there which measure the risk adjusted return. The first one we're going to look into is called Sharpe ratio. Sharpe ratio formula is excess return divided by risk. What is excess return? Return is, for example, we will get 10% return on a stock investment, let's say. That's the return percentage. Now, if you put that money into a fixed deposit in India, you may get 6%, let's say, return. That's a risk-free return. So if I put it in the stock market, I get 10%. If I put it in a fixed deposit, it's 6%. So 10 minus 6, 4 is the excess return. So 4% is the return I'm getting from the stock market additionally for a certain amount of risk I'm taking. So what is the risk? So the risk is then the denominator, and we use the standard deviation, like the same volatility that I've explained before, in the denominator. So return calculation while considering the risk, that is what this ratio is about. So let's go ahead and calculate this and then find out the top 10 banks for us. I want to compare these two tables now, because the table on the left here is only looking at performance. Karur Vysya Bank is at the top, 26%. Now, if you look at the Sharpe ratio, which is considering the risk or the volatility, Karur Vysya Bank drops to 4th. ICICI, which was 2nd, moves to the top, and not even close to Karur Vysya. It's far away from a Sharpe ratio perspective. So this is how the Sharpe ratio can be effective and useful for us to find the risk-adjusted return. So why is this happening? Let's compare ICICI Bank and Karur Vysya Bank's volatility. You can clearly see Karur Vysya Bank, which is the orange line, is a lot more volatile compared to the blue line. So the question here is, Karur Vysya Bank gives me 26% return and ICICI gives 24% return. Yes, Karur Vysya Bank gives me a little bit more, but is it worth the volatility or the fluctuation that I have to deal with? The answer based on the Sharpe ratio is no. The Sharpe ratio says ICICI Bank is a better option because for the risk or the fluctuation, the return is greater in ICICI compared to Karur Vysya Bank. So that is the usefulness of the Sharpe ratio. Now, one more thing I want to point out here is that HDFC Bank and ICICI Bank recently have been not only getting returns, but also their volatility has always been more in the lower range, and that's why the risk-adjusted returns look better for HDFC and ICICI banks. Now, let's continue with discussion. The next ratio, as I said, there are two important ratios for risk-adjusted returns. There is another ratio called Sortino ratio. Now, these are named after people who invented these ratios, and the Sortino ratio, the only difference between this and the Sharpe is the denominator, instead of considering all the fluctuation or volatility, only consider downside volatility or downside risk. What that means is, if the price goes up, don't think of that as a volatility. That's okay. As an investor, if the price goes up, I'm happy and I don't have to consider that as risk. But if the price goes down, then I need to consider that as risk. That is the simple difference between Sortino ratio and Sharpe ratio. Now, when we do this calculation, I'm looking at now 5-year period, and I'm comparing the Sharpe ratio and Sortino ratio to give you an idea why Sortino ratio makes sense or why it gives a different perspective. Now, based on the Sharpe ratio, Indian Bank is at the top, Karur Vysya second, IOB, Indian Overseas Bank, is number 4. But you see on the Sortino ratio top performers, you will see Indian Overseas Bank is number 2. And it's done a much bigger jump over Karur Vysya and the J&K Bank. And even though from a Sharpe ratio perspective, IOB was 0.6 and Indian Bank was 0.79, quite a bit difference there. But when you go to Sortino ratio, IOB is 1.22 and I should have compared with Karur Vysya Bank. Karur Vysya Bank 0.69 to 0.6. There is some difference. But here on the Sortino ratio, IOB is 1.22 and Karur Vysya is 1.21. So it jumps. So now, what does this mean? Why is this happening? So let's take a closer look at this. The bottom chart shows, for example, the Indian Overseas Bank, and I'm looking at the fluctuation only for positive changes, meaning price increases. And then when I'm looking at the negative, which is whenever the price drops, and you can see that Indian Overseas Bank has a much more price changes which are positive, which means the price keeps increasing, whereas the Karur Vysya Bank comparatively has less of those. So Karur Vysya Bank has more up and down fluctuation, whereas Indian Overseas Bank has more upward fluctuation and less downward fluctuation, which puts the IOB as a better stock in the Sortino ratio. Again, I know that it's 1.22 versus 1.21. It's not, substantially different. However, the point here is, if you had used Sharpe ratio, IOB wasn't even, in the picture there. It's far down, but IOB was able to move up because the fluctuation is more positive for Indian Overseas Bank. So I think this kind of illustrates where and how Sortino ratio plays a role. And if you want to only consider downward price movements as risk or volatility or fluctuation, then you should use Sortino ratio instead of Sharpe ratio. Okay. Now let's continue. Overall, except a few minor differences, like I explained, one stock moving from number 4 to number 2, number 3 to number 2, something like that. Apart from that, the top 10 itself remain the same. So the top 10, if you look at purely, performance versus risk adjusted performance, it's not like some stock is moving from number 21 to the top 10 or something like that. So there's no dramatic changes. Yes, there are minor movements, but the top 10 is still top 10. The order may change a little bit. So that's what I'm observed in the overall Sortino ratio analysis. Karur Vysya Bank again continues to be a consistent performer across these. ICICI and HDFC Bank are performing well lately, not only returns but also risk. And ETFs are an attractive option based on, if you look at the last 1 year, ETFs, definitely look like a good option considering the risk. Now, another risk measurement concept is maximum drawdown. So to understand this, let's look at this picture. This is IDFC First Bank Limited's price chart. And the first all-time high that we hit here, from the all-time hit until it reaches to the bottom, if you're measuring that, that's the drawdown. And then again, it goes to another all-time high. And then again, we measure the drawdown to the bottom. And then whichever the change is the bigger one, that's called the maximum drawdown. So this is what this metric is measuring. Maximum percentage change from the peak until that point, whatever was the peak, to the bottom. So this calculation gives us an idea for how steep the price can drop for this stock based on the history. If you go from an all-time high to losing 90% of its value, let's say, that's a big change. So you would have to be okay with, if you're invested in such a stock, and if you're okay with the price going down to such a low percentage and dropping so much of the value, will you be okay with it? Compare this to other stocks where they don't have the history of dropping like 80-90%, then those are relatively stable, so there is less stress involved when it comes to investing in those stocks. So if, depending on your investor profile, you may have a threshold on how much am I willing to go with the maximum drawdown. So let's continue to do the same kind of analysis, the top 10 banks in terms of drawdowns. No surprises here. The ETFs are there because ETFs don't seem to be having such dramatic declines like some of these other banks. So they dominate this metric. Now, some other banks, which ICICI, for example, they also don't seem to drop significant portion of its value from its peak, and so that's an interesting observation there. And then the State Bank of India within the last 3 years have been in the top 10 in terms of not losing a lot of its value, and again ICICI Bank. And also a couple of other banks, come up in the 5-year window as well. Now, let's say, for example, the ICICI example, it's only, they continue to be in the top 10 across all the time frames. If you look at their price chart in the bottom left here, you see that, yes, they've been increasing, but their decline. So if I'm looking at any point of time where there is a decline in price, it is reasonable and it doesn't have the steep decline that, for example, some of these other bank stocks have. And that is why ICICI shows up as one of the top performing stocks in terms of maximum drawdown metric. Now, moving on to the next, we have only a few more metrics to analyze. We're looking at the dividend. So banking stocks and the ETFs, they can issue dividends. And I looked at the dividends that were issued in 2024, for example. These are the top 10 banks in terms of dividends issued. 10 of the 12 public banks issued dividends in 2024. 21 out of the 28 private banks did. And then ETFs did not issue any dividends. Now, how do I come up with this number 3.6% for Canara Bank? So I look at the dividend issued per share by the Canara Bank, and then I divide it by the price of a single share of Canara Bank at the beginning of 2024, as of January 1st, 2024. Now that gives me this percentage. And so dividend data is the only piece of data in this analysis that is manually collected from Yahoo Finance, but then all the other data comes from Microsoft Service automatically. And so in order to keep this analysis updated, I'll have to keep bringing new dividend data into my analysis. So that's why I'm looking only at 2024 in this slide, and you can see who the top dividend paying banks are in 2024. Now, PE ratio is the next metric that I'll analyze. P ratio represents the price to earnings per share. So let's say the earnings per share of a stock is, they get 10 rupees per share as earnings, and then the price of the stock in the market is 20 rupees. So it's 20 divided by 10, 2.0 is the PE ratio. The purpose of the PE ratio is to understand if the price in the market for the stock is overpriced or underpriced, or overvalued or undervalued. And typically, if the numbers are lower, that means that the price is lower. And if the PE ratio is very high, that means it's overvalued. So depending on that, you can take your decision whether you want to invest in a stock which is undervalued. So you think that the price will increase in the future, so that you can invest in it. So that's the way the PE ratios get used. You see the lowest PE ratio, so undervalued stocks, highest PE ratio, which is the overvalued stocks. Now, the top 10 includes 6 private banks and 4 public banks. And then when you look at the high PE ratio, so IOB, PSB, and also HDFC is in the top 10. Those are, the highest PE ratio banking sector stocks. And so those are notable because some of the other ones you may see are smaller banks, but then these are big ones. The HDFC, IOB are there in this list as well. So for ETFs, I don't have that included in this analysis because for ETFs, Microsoft Service does not provide me the PE ratio. And so I've used the average of all the banking sector stocks as the PE for the ETFs. So they don't end up in the top 10 or the bottom 10 because I've taken an average. So I end up in the middle. So they don't show up here. So now that we have completed the individual analysis of many stock market metrics and find the best and the worst banking sector stocks, now it's time to take all of these metrics and figure out how do I find what is my number 1 stock, number 2 stock. And this is where the stock ranking model comes in. So I've built a spreadsheet, which is, I'm calling it as a stock ranker model. And here I have selected 10 metrics. I know we discussed a lot more than 10, but some of those metrics are related. So I just wanted to keep like these 10 to begin with. These 10 metrics are 1-year performance, price performance changes, 3-year, 5-year, 2024 dividend yield, risk, 1-year volatility, 3-year volatility, 5-year volatility, PE ratio, market capital, and the 30-day average day volume. So I've put this into 4 sections: returns, risk, value, and profile, with 10 metrics. Now, depending on you as an investor, your profile, your risk tolerance, you can decide which metric is more important to you by assigning weights. So total weight is 100%. So you can say, I'm a growth investor. I'm only focused on performance. I don't care about the risk. Then you can give your 100% weight to the return section instead of risk or value or profile. So another investor who's a conservative investor might say, risk is all I care about. Everything should be about risk mitigation. Then you can enter your inputs accordingly. And the spreadsheet will actually do all the calculations and bring back the top stocks that are meeting your preferences in terms of importance of the metrics. Okay, so now let me show you what the results are. The first one I'm going to show you is an aggressive investor profile. So in this case, if you look at all the 10 metrics, the table represents the rank of each of the banking stock based on these metrics. So each column represents the different metrics. So 1-year return, 3-year return, 5-year return, dividend. So each of these 10 columns are 10 metrics. And then each row represents a different bank. And for an aggressive investor, these are the top 5 banks using the data as I have today, as of February 14, 2025. These are the top 5 banks for aggressive investors. And among these, Indian Bank and Karur Vysya Bank are pretty close. And then there is Bank of Maharashtra, which is 3rd. And then the 4th and 5th are kind of tied, Union Bank of India, and then the Canara Bank. So basically, if you look at this table on the top, aggressive investor only cares about the returns, right? So I've given 100% of the weight to returns. You see that the green, they're all dark green for the most part, because these are the best banking stocks when it comes to returns. So that gets prioritized. So as an aggressive investor, I'm giving more importance to only the returns, and I don't give importance to volatility or value or market cap. It doesn't matter to me. If I am that type of investor, then you can see here that the volatility ranking is in 20s, 30s. Out of 52 stocks, 35 that's very low. When it comes to volatility, it is not good. But still, as an aggressive investor, I'm not giving importance to volatility. That's why Indian Bank pops up to the top. So in this view, here at the bottom, you can actually see the actual percentage or the actual metric value. So everything is, transparent and displayed on screen here. For an aggressive investor, these are the top 5 stocks. Now, if I go to the conservative investor, now what is important? I care about the volatility. Now, I don't care about the returns, I don't care about the value, I don't care about the profile. If that is my setting, then these ETFs are the top. And you can see that the SBI Nifty Bank ETF and the Nippon India Bank Bs, they are very close, and they are the top 2. And then you have the other 3 ETFs as well. So this one is obvious because you're saying the risk is the important factor for me as an investor. So the model is picking the least risky investments, which happen to be the ETFs. Now, all the metrics are there at the bottom. So you're going to get about 9 to 10% return with the least risk if you're using these ETFs. And once again, the top 2 ETFs are very close in terms of all the metrics. So they end up having appear at the top 2. Now, what if you're a moderate investor, where I'm saying I am giving equal importance to all the 10 metrics? So giving equal importance to all the 10 attributes, then which is my best stock? HDFC Bank comes to the top with ICICI very, very close. So the top 2 are HDFC Bank and the ICICI Bank. And this is interesting when you look at the top table. Based on the last 1 year return, HDFC and ICICI Bank are very good. So they are in the dark green, towards the top in terms of ranking. And then they get the help from the market capital as well, because they are 2 of the largest in terms of market cap. Their PE ratio is not great. That's why you see the red. So the PE ratio is not great, but their volatility is in the, towards the top. So that helps them. And then the recent performance. So basically, the model gives equal importance to all the 10 things, and HDFC and ICICI Bank to come toward the top. SBI is the first, or it's number 3, but it's the best of the public banks. Karur Vysya Bank, which happened to be, one of the top banks, and if I go back to the aggressive investor, Karur Vysya Bank was number 2, and then number 2, but also it was very close to number 1, so it's not very far away. But when it comes to the moderate investor, Karur Vysya Bank is still there in top 5. So Karur Vysya Bank, Indian Bank, they're actually in pretty good options. And then if you want to go with the moderate investor profile, HDFC Bank and ICICI Bank are also there. If you want to stick with a public bank, SBI is in the top here. Now, this is how we can use data to drive decisions. So here are my closing thoughts. Now, in this video, when we did the analysis, we used the stock market data to help us in making our investment decisions. I'm not an advisor, so I'm not giving any recommendations specifically to buy this stock or that stock, but it's all about the process and how do you use the information to get insights. And there is a lot of different insights that you can get, and using the same data, 2 people can take different decisions as well. So it's about the process and the approach. And we used a lot of different metrics, understood what those metrics are, and then using those metrics to determine the top performing stocks and ETFs. And that concept is what I want to kind of drive home in this video about. Remember that this is only one type of analysis. So there are, fundamental analysis that we can do by looking at the bank's performance, like how much profit are they making, how much deposits do they have, how bad is the debt, and so there is a lot of analysis that we can do using the financial statements from the banks. If you would like to see that video, please let me know. I'm happy to do that research and then prepare a video and analysis on that. There are also technical indicator based analysis. I've done a lot of videos around technical indicators, a lot of templates which you can use to calculate technical indicators, and you can use that to kind of know when is the right time to invest in a specific stock. So the other types of analysis are there, so please note that, and ideally you want to kind of at least consider them, and many cases consider the stock metric analysis that we did along with the fundamentals, along with technical, so you can get a more complete picture of the sector. And also all of this data that we shared and I shared in this analysis video, it's all done within a spreadsheet. And as I said, I'm pulling the data from Microsoft Service into Excel. I built this model, and with a click of a refresh button, I can get this data updated, on a frequent basis to actually do the analysis, update the analysis, and help me take decisions using the up-to-date data. So let me, for example, take a quick tour of the template. And here's the spreadsheet, and you can see that this is the stock ranking model, and I've given 25% importance to returns each, so which means 100% is returns, and I can see the data and I can see all the charts. So all of this will get updated whenever I have new data. I can just refresh and it'll pull the data from the market and then update for me. There's also this top 10 view where I can actually click on any specific bank that I'm interested in. So let's say IOB, and I can see if they are in the top 10 in any of these metrics visually quickly. And so all the top 10 performers based on all these different metrics that we looked at, everything is again fully automated in this spreadsheet. And then we also have the analysis where I can look at the market cap, the Nifty back index. I can do this risk versus reward chart, and I can quickly look at, okay, over 3 years, how the performance has been, how the 1 year period. So I can do that. I can also compare two different banks. So for example, if I want to compare HDFC Bank versus Karur Vysya Bank in terms of price, in terms of volatility, in terms of all these metrics, how do I compare two different banking stocks and tell me which one is better? Again, all of this fully automated. So if this is something that you will find useful, let me know. And if enough people are interested, I'm happy to spend some time in polishing this and making it ready to be used by somebody. And then I can publish it on my website. So please let me know if you're interested in this template. And also if you'd like me to do more such analysis videos, please let me know in the comments. That will help me decide what the next video will be. Thank you so much for watching. I'll see you soon.